Hello, welcome back to the show. So in today's video, I'll be ranking the Max 7 stocks based on these few indicators. I'll be ranking them based on its fundamentals, based on the mode of the business, as well as the valuation itself. So these are the Max 7 stocks, and the first one I'll be ranking is Tesla. So Tesla is a stock that is down around 7% year to date, and it is currently trading close to a 200 times price to earnings multiple. And for Tesla, the core business itself is shrinking. So if you're to look at the Europe sales as well as the deliveries over the past few years, the bottom portion shows the deliveries, and the deliveries have been declining for a few quarters already. And then you have the top portion as well, which is the EU sales. The Europe sales have been dropping every single quarter since Elon Musk became politically involved, and that is hurting Tesla's core business. So Tesla still derives a lot of its revenue through car sales. Although it's touted as an AI company, it still derives the majority of its profits from the car sales itself. So for Tesla, the narrative for it now is your robotaxi story. So Elon Musk, he recently said that he'll be kicking off the robotaxi service by starting off with Austin with 10 vehicles and expand to thousands, moving into more cities if the launch goes well. Musk said this in the interview that they had. But if you're to contrast this to Google itself, Google's Waymo already has 250,000 paid robotaxi drives every single week in the US itself. So you have one company that is already doing the robotaxis, and then you have another company that is still in the process of creating the robotaxis. So I think Tesla is a dangerous stock for you to invest in today, and here are some of the risks related to the business. So Tesla's fundamentals are poor. It has a 2% net income margin. This is worse than a lot of your different car companies. It's a retail stock, and anomaly. The company has a key man risk as well, because if Elon Musk steps down, the stock could easily halve or even drop to a normal car company's valuation. So 200 times earnings for this company is unsustainable. It has to come down. Either the earnings has to catch up or the stock price will have to come down. And currently, the core business is weakening, so I'm not too sure how the earnings can pick up again. But let's see if the robotaxi story works out. So for Tesla, it's in the sell category. I don't think I'll be anywhere close to buying this stock anytime soon, simply because the fundamentals are not aligned to the stock price itself. Next Max 7 stock is Apple. So Apple is currently trading at a 31 times earnings, and currently year to date it's down around 16%. Apple is one of the Max 7 company that is still in a bear market. So for Apple, Berkshire Hathaway has been selling Apple non-stop. They have sold around 65 or even 67% of their initial Apple position already, and they've sold at prices that are below today's price. So clearly Warren Buffett thinks that Apple is overvalued even at today's price, and that's why you're seeing a lot of selling over here. So for Apple, the growth has been stagnating over the years. And if you're to just look at the revenue growth over the past 3 years, the revenue growth over the past 3 years has been flat. So this is a company, a juggernaut company that is having flat revenues for the past 3 years. And that is when you see the decline of a giant like Apple. So Apple's growth has been stalling for years. The only story now is Apple Intelligence as well as the services growth. Services has been growing rapidly, but the problem is services only makes up a very small percentage of Apple's total revenue. So for Apple, it has incredibly high ROIC. So it has a high ROIC of around 33%, but the reinvestment rate is only 2.5%. So the expected growth from a company is your ROIC times your reinvestment rate. So when your reinvestment rate is low, even if you have a high ROIC, it means that the company isn't able to grow. So for Apple, they can't deploy the capital to grow the company even further, and that's why almost all of their free cash flow is put into buybacks. But buybacks at high valuation is not good for the company as well. You want buybacks at low valuation. This is normally the most shareholder friendly. When you're buying back the stock at expensive prices, it is not shareholder accretive at all. So for Apple, it's currently in the whole category. It's a mega company, almost a consumer staple already, but I don't think it is anywhere near the buy category. And so that's why it's in the whole category for me, or even the sell category as well. Next stock is Nvidia. So Nvidia year to date is currently up around 2%. The stock is trading at a price to earnings multiple of around 45 times, and from its 52-week low, it's currently up around 50%. So for Nvidia, it has experienced explosive growth. So the company over the past few years or so has 10x its revenue itself, and you're seeing that with multiple contraction as well. So over the past 3 years, Nvidia is currently now trading at its lowest valuation as compared to the past. It means that the earnings itself is outpacing the price increase of the stock. So for Nvidia, here are some of the headwinds for the stock. So the first one is just reduced AI costs in the future. So this is from Andy Jassy, Amazon CEO. And this is what he said. So he said that AI does not have to be as expensive as it is today, and it won't be in the future. Chips are the biggest culprit. Most AI has to be up to date and built on one chip provider. It's pricey. So he's saying that Nvidia chips right now, which is what majority of your Amazon machines work on, is expensive today and the price will likely come down in the future. This is what Amazon CEO thinks. And the other headwind for the business is simply just your hyperscalers increasing capex at such a high rate. And this will likely normalize in the future. And when that normalization occurs, then you'll see Nvidia growth slowing and the multiple will contract on the stock as well. So for Nvidia, I think it's in a hold category. I'm not too sure what the mode of the business is, but I don't think it's in the sell category. Neither do I think it's in the buy category. Next stock that I'll be ranking is Microsoft. So Microsoft year to date is up around 10% and currently now it's trading at a 35 times earnings. So it's trading at quite a hefty valuation. So for Microsoft, it has a full suite of products. So the revenue streams are extremely diversified. You have your cloud revenue coming in, you have Microsoft 365, Windows, gaming, LinkedIn, even Microsoft Search as well. And all these portions, they make up the entire Microsoft business. And that's why I think Microsoft is one of my buy and hold companies forever. So for Microsoft, the cloud story is growing as well. So Azure revenue has picked up and it is currently the highest growing one out of all three different cloud providers. So Azure is growing at around 33%, whereas Amazon's AWS is growing at 17% and Google's GCP is growing at around 28%. So for Microsoft, the competitive advantage that they have is their ability to bundle everything together and sell it as a package, and that won't stop and no one will be able to come in and steal their share. So for Microsoft, this is my rating. My rating is in a whole category. Currently now it's trading at a very hefty valuation, a 35 times earnings. I don't think it will vastly outperform the market at this valuation unless the growth re-accelerates. So for Microsoft, it's in a whole category for now. I would like to add it at around $400 a share again. That was my initial entry. So let's see if it gets there again. Next stock is Meta. So Meta year to date is up around 11%. Currently now it's trading at a 26 times earnings. So for Meta, this is their earnings from last quarter. Their earnings were just stellar all across the board. So revenue grew by 16%, income from operations grew by 27%, and overall the net income grew by around 35%, and then your EPS grew by 37%. So this earnings report from Meta in Q1 of this year was just incredible. And if the company can continue doing so, then I don't see why Meta shareholder will be unhappy today. So for Meta, they're introducing some form of AI ad automation as well. So they're fully integrating the entire ad ecosystem into their platform itself, from creation of ads to publishing of ads to monetizing of ads. So for Meta, this is a bull case for the stock and likely a bear case for companies like Adobe or even the Trade Desk. Meta is a company that is incredibly high quality and I don't think it will go anywhere. But for Meta, the valuation right now is high. The business is cyclical as well and it is concentrated in one portion, which is your advertising portion. And when an economic downturn comes, advertising is normally the first one to be hit. So it has an impending lawsuit with the DOJ as well regarding its monopoly in the social media space. And if they're told to divest their Instagram platform, then this could be extremely bearish for the stock. So for Meta, my current rating is in a whole category. I think the company is high quality, but currently now at the 26 times earnings, I think it is priced for a lot already. Next stock is Amazon. So Amazon year to date is down around 5%. Currently now it's trading at a 33 times earnings. So for Amazon, this is the story of the business. So Amazon has always been a company that has suppressed its earnings for future growth. And this is what Andy Jassy said as well. He said, we spend this capital up front, even though these assets are useful for many years. We only start monetizing these capital investors many months after we spend the capital and over many years, which leads to attractive long-term free cash flow and ROIC. But in periods like now of unusually high demand, you're deploying a lot of capital. We continue to believe AI is a once in a lifetime opportunity. The demand is unlike anything that we've seen before, and our customers, shareholders, and businesses will be well served by our aggressive investing today. So for Amazon, if you're to look at their R&D numbers, their capex, their reinvestment rate, they're always the highest one up there, and that is why Amazon's earnings are likely suppressed. If you're to just remove the R&D number and swap it with Google's R&D number, you will likely see Amazon having a much lower price to earnings multiple than it is today. So for Amazon, my thesis is simply just a margin expansion story. So for Amazon, if you're to look at the margins over the past few years, margins have been increasing, and I expect them to continually do so with the R&D and capex increases. So your R&D and your capex can be used to increase operational efficiency to push up the margins over time. So if you're to look at AWS margins over time as well, AWS has increased its margins from around 20% all the way up to around 35% today. Same for the North America business, from 1.2% up to around 6% today, and even in the unprofitable international portion as well. So for Amazon, the current valuation is very sound as well. The stock now is trading at a 33 times earnings. Amazon is currently trading at its lowest valuation in its history. So you're not paying up for Amazon, you're currently now buying a stock that's trading at its lowest possible valuation. So for Amazon, this is my rating for the stock. I think it is currently now still in the strong buy category, although it has appreciated by quite a bit since the April dip already. I still think this company is one that will achieve outperformance over the next few years if they can continue on this trajectory. Of course, the company could face a lot of macroeconomic headwinds in the future with all these tariffs and trade war, but I don't expect that to hurt Amazon in the long term, and that's why you're seeing bullish super investors like Bill Ackman buying into this one. So for Amazon, it's in a strong buy category. I still feel the stock price today is attractive. It is currently now trading at around fair value, but you will likely get above market returns at this price as well. Last stock is Google. Google is currently down around 11% year to date and currently now is trading at a 19 times earnings. So for Google, here are some of the headwinds for the business. It is simply just your LLMs, your DOJ breakup as well. So this was an article that was released by Barclays. So Barclays says that Google stock will fall 25% if the DOJ forces Google to divest their Chrome business. And this is what Barclays analyst Ross Sandler has said. The analyst has said that selling Chrome used by 4 billion people could shave off 30% of their EPS, given that the browser's contribution is 35% of their overall search revenue. So for Google, if they lose the Chrome portion of the business, it is incredibly bearish for the stock. But let's see how this one plays out. It will likely take a few more years before we come to a resolution. So for Google, here are some of the tailwinds for the business, and this is from Pershing Square, which is Bill Ackman's fund. So he said that revenue grew at a robust 15% rate, led by strength in its core advertising business and rapid deployment of AI innovations. In search, the company has successfully rolled out AI-powered summaries called AI Overviews. Early engagement with AI Overviews has been highly encouraging, with consumers searching more frequently with more detailed queries and clicking through at a higher rate. So he's saying over here that Google is successful with its monetization of AI, and he also stated that despite tremendous business momentum, Alphabet still trades at an 18 times forward earnings, a highly discounted valuation for a business of its quality and growth prospects. As the company executes on its AI potential and margin expansion opportunity to drive rapid earnings growth, we expect its stock price to increase to better reflect its strong underlying business fundamentals. So Pershing Square is clearly bullish on Google. I'm bullish on Google as well. But for Google, it's in the buy category. It's not in the strong buy category because the company has too many headwinds. If it loses its Chrome segment, then it could be incredibly bearish for the stock. I don't think the stock has priced in that one yet. And the other portion is your LLMs becoming exponentially powerful. So if they become more and more powerful in the future, you never know how search will look like 5-10 years from now. And that's why I think Google today, it's in the buy category. It's not in the strong buy category, but it is a stock that will likely give you outperformance over the next few years. Let's see how this one plays out, but this is my ranking for your Max 7 stocks today. I hope you guys have found this one useful and invest